Hello and welcome to CIMA F2 Financial Management Chapter 7. This chapter is called Financial Management, like the entire paper, and it emphasizes on the skills that are core to any management accountant, and that is to interpret the set of financial statements. It's very important to emphasize that people usually enjoy this chapter on one hand because you have all the ratios to calculate. And just for your information, there were some records out there where students calculated up to 17 ratios on a case given, but with a few ratios and some strong comments was really guaranteed pass, whereas just with 17 ratios and no comments was zero chance to pass. The person failed. So make sure you never ever feel in your safety area of calculating lots of ratios, which you are supposed to know from your F1 paper, where you had some awareness of basic interpretation of data, but you go ahead and basically you go beyond what we are saying here, calculating the series of ratios. So make sure you do the talk and interpret what they mean. Now, in terms of a big picture, what can we do with financial ratios? And when we analyze a set of financial statements, what we're aiming is to get an understanding of the company's profitability, liquidity, gearing, and investor returns. And for each of these categories, you would have certain ratios you need to be familiar with, but more importantly, you need to interpret them and also be aware of their limitations. So you have this chapter, of course, in your Express Notes, which I assume you all downloaded from our website next to your videos. I'm not going to explain to you here, these are the ratios and you're taking for gross margin, gross profit divided by revenue. I assume you'll all be quite confident and comfortable to pick up the data and put it into those ratios. So make sure you know your categories for profitability. Gross margin, net margin are two ratios that managers should monitor very frequently. Return on capital employed, it's more like annual ratio. Who would look at the return on the capital they employ? The people who employed their capital, and that is equity owners or holders and loan providers, long-term providers of debt, and the higher the return the better. Is that correct? Well, you want a steady pace increase. So make sure you read all this: asset turnover, how efficiently you use your assets. Be aware of all this. We put here the key ratios you need to be aware of. With liquidity, again, there are some vital ratios here: quick and current ratio, famous, very much into the attention of management. Of course, very important, they vary from an industry to another. So you have to be careful in the context that you are provided, in what industry you are. Also, you have to be aware of what happens in previous periods. Can you establish trends? Are these ratios, any ratios, whether we talk about liquidity like we have here, or we talk about profitability, are they stable? Are they steady? Are they growing? And also here you have very important three elements which refer to the working capital. So all of you should be aware of what working capital is. Now you're drilling down a bit and putting some values on inventory days, how many days you take to turn around inventory, receivable days, how many days you take on average per annum. So these will be expressed in days to cash money from clients, and how long does it take on average per annum to pay your suppliers. Very important ratios. I can't emphasize enough. You're all aware, especially with the financial crisis, but even before, I think people have become more acutely aware of liquidity issues, and you want to obviously prevent rather than cure. Sometimes curing could be quite late in terms of liquidity issues. So you want to make sure you understand your liquidity ratios very well. I made reference to the working capital ratios. May I just quickly say that you have here the calculation of what is called working capital cycle. So you take the inventory days and receivable days, and you take out the payable days, and that number of days, X days, whatever that takes you to, represent the number of days a company has to finance itself from external resources, external financial resources. So very useful data to know for current period, but also you can use it in forecast. When it comes to gearing, it's very important to know these two ratios which indicate the degree of financial risk that the company has. Gearing, pretty much to remember, is debt to equity, but remember you have to compare like with like, so this debt must be long-term debt because equity, it's a long-term employed form of funds of the shareholders. So in gearing and interest cover go together, they should give the same signals. When it comes to investor return ratios, very quick highlight. As you can imagine, the main stakeholders that will benefit of these particular ratios and look at and search for them and compare them and prepare trends would be your shareholders or potential investors. So what are they looking for? Dividend cover. First of all, is that company stable enough to produce steady profits to cover or to have the potential to offer dividends? So how many times that profit is higher than the dividends, ordinary dividends proposed for the current period, is an indication of the financial health of that company. What about the dividend yield? Well, dividend yield, if you think you're taking the dividend you are getting in a period of time relative to its share price. So share price is how much it would be paid, the investment, and dividend portion is, let's say, the return on that investment. So pretty much it's a return on investment related to the to your dividends for the shareholders. So make sure you carry on reading. You know who's basically looking at these ratios. Just before I move into limitations, I wanted to point out a bit of exam technique you need. If you get a ratios question, I would say you're lucky as long as you're confident to jump into interpretations. Make sure that you do not jump into calculating ratios first thing. First of all, I would recommend to you to give a big picture to the examiner of the context of that business. So before you calculate any ratios, try to summarize the big picture of the company's position and performance in just a few words. So in other words, highlight to the examiner, is that company in a process of expanding? Is that company maybe overgeared? Is that company sort of losing profitability? So give them the general big picture. Everybody wants to understand the context. The second thing I would recommend to you to do is to identify and have a good understanding, who are you talking to? So what are you asked to do? Who are you asked to report to? Who are you reporting to? So who could you report to? Well, could be shareholders, could be managers, could be any form of employees, bank, etc. And think, if you're a bank, what would they care about? Maybe they would care about the profits, but also to the extent of the cash flows available to pay back the interest and, of course, the principal component. So make sure you know who your report is addressed to and gear it to that particular interest of your stakeholder. Now, finally, get to some numbers. You can put your calculator into function and do some ratios. Make sure you stick to some relevant ratio. Don't feel you have to do them all. Make sure you know you can be flexible, and sometimes you can look at things like what sort of industry it is. If it's a retailer, for instance, maybe you'd like to calculate a ratio which you don't see in this chapter, you won't see in your notes, such as, let's say, revenue per square meter of shop floor space or sales per employee. So there are lots of ratios which suddenly could spring to mind that could be highly relevant. What else do you have to do? Well, finally, after you do ratios, remember most marks would come from your comments on these ratios. So this is the body of your report, isn't it? Ratios, in fact, could be an appendix, but it's where the comments are really creating the core of the report. And finally, don't forget to mention about limitations of ratios. So that's what we strongly recommend you to do in a question to be successful. Remember, this paper is all about financial management, so interpreting a set of financial statements goes without question. That will be present in your exam, will feature in some form for quite a few marks, a significant proportion into your exam. Any limitations of ratios? I'm sure you're all familiar, or if not, just know there is no such thing as clear definition of ratios. You will see in practice there are lots of analyses, lots of apparently same ratios calculated in different ways. So keep flexibility, keep an open mind. As I said, maybe you may have to create some ratios, but remember they are not a precise science, and that can create inconsistent decisions as well if you're not aware of that. So make sure you compare like with like from a period to another. Financial statements may have been deliberately manipulated or creative accounting. Well, this is less and less possible given that the financial accounting rules become stricter. Nevertheless, companies can do certain transactions at the year end, let's say sell a bit more to inflate the sales figure, to inflate the profits, and then maybe reverse saying that they had returns. But this is not the kind of thing. Just be aware that accounting data can be to an extent, let's say, subjective, although it should not be based on the current accounting rules. As you know, different companies may adopt different accounting policies, so if you want to make a comparison across companies, you will have to pay attention. Do they use the same accounting policies, for instance, for depreciation, for inventory valuation, and so on? They may use different managerial policies in terms of commercial terms and so on, and again, they don't make things comparable anymore when you calculate the working capital ratios. So you have to be aware of that, of the limitation of the information, because obviously financial analysis is as good as the input of information you're putting into the system, into your ratios. Statement of financial position figures may not be representatives. Usually, again, depends, understand the seasonal trade, what sort of business is it? Is it beer industry? Does it have a seasonal thing? Ice cream, traditional example, and so on. The impact of price changes over time caused by inflation, would that affect figures? Of course, if you think of your non-current assets, if inflation occurs, their value is distorted, but then when you calculate ratios about how efficient you utilize your assets, it may look like a company with older assets has a better return, but in effect, in medium term, in fact, not just long term, that will turn against the company if you don't upgrade your non-current assets. These are just some highlights on such a fascinating chapter. Make sure you do practice. You don't just practice the numbers of doing ratios. You are just focusing on how to comment, how to interpret, and potentially make some comments or recommendations. All the best. Enjoy this chapter and all the others, and hope to be in touch with you for the next chapters.